Hello, everyone, and thank you for joining the first class. Today we'll discuss the first topic, which is Introduction to Finance and Accounting. So let's start by defining what is innovation. The main topic of this course is to understand the sources of finance and how finance and accounting can help an innovative young company to start the business and then grow along the line. So understanding what is innovation is important, obviously, for this topic. And we can define innovation as the conversion of knowledge and ideas into new and improved products, processes, or services. And these might be good for both commercial use or just for the public good. So it is important to define innovation as the creation of knowledge, but also the dissemination of this knowledge that has been turned into products or services. Of course, when we talk about innovative companies, in a lot of cases, we are looking at young companies that are maybe entering a completely new market that is novel, does not have technologies already developed in this market. And so these companies usually have a long way ahead of themselves. And so they require maybe a lot of funding. And this funding is usually scarce. So the amount of cash that they can have is limited. And so they need to be careful and aware of how they use their cash in order to avoid running out of it and therefore facing bankruptcy. And so the topics of this series of videos will be to help you understand concepts of funding, accounting, and because this is important to avoid failure and have an appropriate cash management for young and innovative companies. These type of classes and knowledge can be useful for both innovation and startups that start and grow independently, but can also be applied to existing businesses. For example, imagine a large established company that decide to venture into new areas. You can think about, for example, Google, that is starting a AI self-driving company, which is called Waymo. Google is a big company, but they're starting a new venture to take advantage of their resources and implement a self-driving technology. Similar topics, knowledge, principles can be applied to both startups as well as Google and Waymo. So let's start with the first topic, which is the role of accounting information. So what is accounting? So accounting is an information system to collect, analyze, and disseminate quantified economic activity that is relevant, reliable, and understandable. Its main purpose is to communicate economic information. But as the definition states, is not only communicate, but the first purpose is actually to standardize and to have something on paper or on Excel that we can communicate, that we can identify, quantify. And so it's probably one of the main languages of business. If you do not understand accounting and finance, it will be very hard to discuss and talk about business in a general context. Someone might talk about revenues, might talk about profits, might talk about debt. These are all concepts that are very relevant and that we will be covering in this series of classes. So a couple of questions we can answer and we can ask ourselves. Then encourage yourself to think about the answers before you move on to the video. So maybe pause the video after these questions, think about yourself, and then I will provide the answers in the next few slides. So the first question is, who are the users of financial statements? And the second question is, what is the difference between financial and management accounting? So in terms of the first question, who are the users of your financial statements? Or in other words, who cares about accounting and your financial statements? It's a very long list of players, and they obviously do so for different reasons. So the first set of players is obviously the management and the executives in the company. They want to understand how the business is doing, and obviously understanding the financial statements, the revenues, profits, level of debt. All these are very relevant topics that the management wants to understand in order to implement their strategy. The second set of players is the banks. Obviously, banks are interested, especially if you are either looking for a loan or if the company has already raised some funding through banks. They want to understand that the company is in a good financial position that is able to pay back existing or future loans. The government is obviously interested mostly because they want to raise taxes out of the profits that the company generates, and so they want to see yearly or quarterly financial statements. If you have investors or if you are looking for investors, they will also be interested to see either your existing accounting financial statements or your maybe cash flow projections, or how you see your company developing itself in terms of financials in the next 1, 2, 3, 5 years, and so on. Employees might also be interested. They might want to know whether the company is doing well, and in some cases maybe they have stock options, and so if the company is doing better, their stock options will be more valuable. And at the same time, if the company is not doing well, they might be worried that they might lose the job very soon. So employees are also interested to understand the financial of the company. Suppliers, they might be interested to understand whether the company can actually pay the goods that is buying from them, especially if they are providing some sort of trade credit, meaning that they give you some goods, but you will pay in 30, 60, or 90 days. If you will be out of business in 30 days, they might not see their credit paid back, so they might be interested to know more about your financial situation. The general public might be interested for many reasons, especially if companies are of interest for public goods. You can think about utility companies. The public might have different interest in your company, but overall, there is a long list of players that are interested in your financial statements, in your accounting, so understanding how to communicate with them is obviously relevant. There is two types of financial accounting. One is called financial accounting and one is called management accounting. So the first one, the financial accounting, is the one that you usually see in listed companies. And this is because they are listed, and so the public wants to know how these companies are performing. Management accounting, on the other hand, is usually for internal purposes or special purposes. And so they can vary depending on the type of company, the type of management, and so on. Here I outline the main differences, and we will go through them in more details now. So when we talk about financial accounting, again, we look at something for general purpose, and usually all companies apply the same principles in this type of accounting. The detail of the report is usually aggregated, means that it comprises all subsidiaries, all products, all regions of the company. On the other hand, if you're looking at management accounting that is dissected, means that it can vary, depend, and can look only at certain products, certain subsidiaries, or certain regions where the company is operating. For example, you might be interested to know how a certain Facebook marketing campaign is performing, and so you want to see how certain products that you're advertising are performing for the last day or 1 week, and so on. On one hand, financial accounting is regulated, while management accounting is unregulated. And this means that the government puts in place some principles, and companies that are disclosing their financial accounting statements needs to follow these principles. On the other hand, management accounting is unregulated, and so that it can be created for special purposes, and so can follow different formats that the company finds particularly useful. The timing is also different. For financial accounting, you're looking at infrequent releases. Usually this can be either quarterly or yearly releases. On the other hand, management accounting can vary from whatever the company wants, even 1 day or 1 year or 6 months. In the case of Facebook, for example, Facebook marketing, we discussed just a few seconds ago, you might want to know daily or even hourly how a certain product is performing online, so that you can have a better understanding of how the company strategy is doing in certain products, certain marketing campaigns, or certain regions. The time horizon also differs. So when you're looking at financial accounting, this is usually backward. So for example, the company might issue an income statement that shows the revenues and the profits, but this is for the previous either 3 months or 12 months. So we are looking at the past. On the other hand, management accounting can be both, can be backward, for example, last day, last week, last year, but it can also be forward. For example, a startup might design a cash flow projection for the next 1, 3, or 5 years to understand how much capital they need to raise and maybe forecast the revenues, cost that they will be facing in the future. In some cases, for example, you have GAAP is called, which is general accounting principles, and this is how the US government requires companies to disclose their information. Overall, over the next set of slides and classes, we'll focus on management accounting because this is more relevant for innovative and young tech startups. So what is the role of finance in value creation? I like to give examples that are applicable to everyday lives to explain some basic finance concepts so that it's easy to understand what we're talking about. So imagine you want to buy a house with a mortgage. So your house will be your asset. Your mortgage will be your liability. If you want to pay 1 million for your house and you have your own capital, or also called equity, of 600,000, your mortgage will be the difference between 1 million and 600,000, which means that you will need to ask the bank for $400,000. So you have on one end a house of 1 million, and then you will finance the house with 600,000 in equity and 400,000 in mortgage. Of course, this is also called leverage because you are using both your money as well as someone else's money, in this case, the bank. And so when you're leveraging, means that both your return as well as a potential loss will be magnified. So for example, if your house is worth 1.5 million in 1 year, your mortgage will still be 400,000. So this means that your equity will move from 600,000 to 1.1 million. Okay, and this is the difference between the value of 1.5 million and the mortgage of 400,000. So your equity basically doubles despite the fact that the house is only increasing in value by 50%. The same is also true if your house goes down in value to 500,000. So I encourage you to do this exercise and see how much your equity, so your own asset that you actually own, will decline in value if the house price goes down from 1 million to 500,000. So in general, when we talk about finance, we are looking at financial markets. And so when we are looking at firms, firms are interested in raising equity and debt to invest these sources of finance to buy assets and make future operations and create value for their shareholders. So when we are looking at firms, we are looking at the exact same situation that we are considering for the house. So on one end, they have assets, such as your house. On the other hand, they will have liabilities, such as your mortgage, and equity, which is the difference between assets and liabilities. So in finance, there is a number of choices that you as an individual, as well as companies, need to make. So if you're looking at, again, at the example of the house, when you want to buy a house, you have 3 main financial decisions to make. If you think of what these decisions are, this will become clearer also what companies need to decide. So to start, you need to decide what you want to buy. So are you looking for a house? Are you looking for an apartment? Do you want a swimming pool, a garden? So what type of asset, what type of house are you interested in? Once you identify maybe all these questions and the areas, the city area you are interested in, you need to decide what is your budget. So how much do you want to spend? You want to buy a house for 100,000, 500,000, or 1 million? And these obviously will have different consequences on how big it is and the type of amenities that are included. And the third decision is how you want to finance the house, which is of course related to the first two questions. You want to only use your own capital, or maybe you want to ask for a funding for loan or mortgage to the bank. This is not very different from what companies go and decide on a daily basis. So the first thing is they need to decide the type of investments or disposal that they want to achieve. This is also called capital budgeting decision. And companies need to decide every day whether they want to invest in tangible or intangible assets. For example, they might want to buy a new computer, or they might want to spend some money in R&D, research and development. So every day they need to decide how they're going to deploy and invest their cash. At the same time, they also need to decide on their financing decision. So where is the capital coming from? They might want to raise funding from banks for debt, for example, or they might want to raise equity. And so this is very important, especially for startups, which usually need to raise equity to finance their hires in terms of employees, research and development, maybe buy new machinery, new plants, and so on to start their company. The capital structure is the mix between your types of funding. So again, the role of accounting and finance in value creation for new innovations is divided in two things. On one end is the investment or capital budgeting, which is also what you want to invest in. And on the other hand, you have financing, how you want to pay for it. And these decisions will be critical, especially for early stage companies that need a lot of capital, but at the same time are burning capital very fast and they run the risk of bankruptcy.